Like most Marylanders, you probably woke up with one burning question on your mind. How can I get my cash value to sweep the market like an Orioles Red series? Well, while I sweep up this trash out of our precious Chesapeake Bay, let's talk about Index Universal Life policies. You see, an Index Universal Life Insurance plan differs from a traditional whole life plan in that you can actually receive an interest rate based on how the market indices perform. So rather than some small 2 to 4% rate of return on your cash value, you can potentially get a return as high as 12 to 15%, just in 1 year, with most IULs performing on a 20-year average of 6 to 8%. Of course, that kind of cash value can really compound over time. Now, how does this work? So in traditional whole life, when you pay your premiums on a policy, a portion of that premium payment is going to paying the cost to be covered. This is called cost of insurance, and in the beginning years of your contract, that cost of insurance is at its highest. But as you pay into that policy, you are slowly paying down your cost of insurance because technically you are now being covered for less and less. So portions of your premium start to collect in a cash account. That cash account then receives an annual interest rate based on one of the stock market indices like the S&P 500, the Dow Jones. Now, much like most things in life, this comes with a cost-benefit trade-off. A traditional fixed whole life policy is far more secured. Your lifetime costs are built into the initial premium payment, and as long as you make that payment, you are guaranteed that you will have that death benefit. So effectively, you're trading in the security of always having that death benefit for the cost of a smaller return on that cash. In an Index Universal Life policy, you have an expanded window of interest rate that you can get on that cash value, but your cost of insurance will actually raise each year as you get older. And if you're not overfunding the policy, this can eventually put your policy into trouble of lapsing. Now, as long as your premiums and interest in the policy eclipse the cost being taken out, you'll be able to maintain the coverage. So the IUL is effectively trading in a little bit of security for higher potential growth. Now, it's professionals like us here at Bay Life Brokers that are supposed to help plan this properly, making sure that we avoid that worst case scenario. Done so properly, in an IUL, you can find yourself having a permanent death benefit with several $100,000 of cash value, which as long as coverage is maintained can be pulled out tax-free.